Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the corporate jargon so you don't have to. But today, we're diving into a company that might be facing some interesting challenges, but we'll get to that. This is Luvu Brands Incorporated, and they just dropped their quarterly report, a 10Q for the period ending the 31st of December 2025. Now, normally these are dry, full of numbers and legalese, but often beneath the surface, there is a story. Let's see if we can find it. First off, let's get a snapshot of the company's financial health. As of the 13th of February 2025, they had a little over 76 million shares of common stock out there. That is a key number to keep in mind as we look at how the company is performing. When we look at their balance sheet, which is like a snapshot of what the company owns and owes at a specific time, things are not entirely rosy. On the 31st of December 2025, their total assets were about $11.1 million. But a big chunk of that, over $9.6 million, is liabilities. That means they owe more than they own, which isn't ideal. Let's zero in on that. Their total assets stood at $11,141,000. That includes things like cash, inventory, and equipment. But then you see their liabilities at $9,602,000. This means they have a lot of debt and other obligations on their books. And a significant portion of that is current liabilities, meaning debt that is due within a year, totaling $4,871,000. That is a lot of immediate bills to pay. And the bad news doesn't stop there. They have an accumulated deficit of $5,534,000. That basically means over time, the company has lost more money than it has earned. This shows a history of losses. Now let's look at how they've been doing in terms of making money or losing it. Their statement of operations for the 3 and 6 months ending the 31st of December 2025 paints a pretty clear picture. For just the last 3 months of 2025, they reported a net loss of $765,000. That is a significant chunk of red ink. And looking at the 6-month period, the loss balloons to $897,000. This suggests a trend of losing money is continuing. On a per share basis, that translates to a loss of 1 cent per share for both the 3 and 6 month periods. While that sounds small, it adds up across millions of shares. Interestingly, they recorded an income tax provision of $813,000. This seems counterintuitive for a company reporting a net loss. The report details this is primarily due to tax effects from a new operating lease. It is a bit of a head scratcher, but important to note these adjustments. However, when they strip out certain items to get what they call adjusted operating income for the 6-month period ending the 31st of December 2024, it shows a positive $407,000. This is a non-GAAP number, meaning it is not a standard accounting measure. They're trying to highlight the operational performance without considering things like depreciation or interest. It is a way to put a slightly better spin on the numbers. But we have to remember the actual GAAP numbers show a loss. This section tries to explain how they get to that adjusted number. It is a common practice for companies to show these adjusted figures, but it is vital to always look at the official GAAP numbers first. Let's talk about sales. They've broken down their revenue by segment. A significant portion of their sales, around 36 to 39% in the periods reported, comes from or goes through Amazon. This shows a heavy reliance on one major online platform. It is a double-edged sword. Amazon can be a huge sales driver, but it also means they have limited control over their distribution and customer relationships. Their wholesale business seems to be struggling. Sales in this segment were down 7% for the 3 months ending the 31st of December 2025 compared to the prior year. They blame competition from low-cost international manufacturers. This is a classic challenge many companies face. On the flip side, their direct-to-consumer sales through their own websites saw a slight increase of 1% for the quarter. They attribute this to stronger sales on their Liberator website and increased marketing focus on higher return channels. It's good they're seeing some growth here, but the wholesale decline is a concern. Now, let's look at their gross profit margin. This is the profit they make after accounting for the direct costs of producing their goods, like materials and labor. For the period ending the 31st of December 2025, their gross profit margin was 26%. That is a dip from 28% in the prior year's quarter. They say this is due to increased freight and tariff costs. Tariffs in particular are a consistent headache for businesses involved in international trade. Their operating expenses, which include things like marketing, salaries, and rent, were up for the 3 months ending the 31st of December 2025. These expenses were about $1.7 million or 25% of sales. This is up from 24% of sales the previous year. A big driver for this increase, as noted in the report, is rent expense related to a new operating lease. Summing it all up, the net result is a significant turn from profit to loss. They went from a net income of $192,000 in the last quarter of 2024 to a net loss of $765,000 in the same period of 2025. As we saw earlier, a good chunk of this was due to a large tax provision, but even without that, the operational trend isn't looking strong. Looking at cash flow from operations for the 6 months ending the 31st of December 2025, they actually generated $365,000. This is a positive sign that their core business activities are bringing in cash, even though they reported a net loss. They mentioned that a decrease in accounts receivable and inventory helped this figure, which means they collected money owed and sold off some stock. However, their investing activities show a use of cash, $49,000, primarily for purchasing factory equipment like a forklift. This is normal for a business, but it means they are spending money to maintain or improve their operations. Financing activities show a small positive of $35,000 for the period. This was a mix of borrowing and repaying debt. They're taking on new secured loans, which is a way to fund operations, but they're also paying down other debts. Let's touch on their adjusted EBITDA for the quarter, which came in at $291,000. Again, this is a measure that smooths out some of the non-cash items. While it shows a positive figure, it is important to remember the Gaja net loss. The gap between adjusted figures and actual Gaja results is something to always scrutinize. On a less exciting but important note, the company states they don't use any off-balance sheet arrangements. This is good for transparency. It means there are no hidden obligations lurking in the background. Now for the risks, they highlight the impact of international tariffs, especially on materials sourced from countries like China. They explain that these tariffs can increase their costs, forcing them to raise prices. This in turn could lead to fewer customers and lower sales, which is a clear concern for their future. Finally, the report includes standard certifications from the CEO and CFO ensuring the accuracy of their financial reporting. These are crucial for regulatory compliance. So, what is the story here with Luvu Brands? On one hand, they're generating some operating cash flow and their direct to consumer business shows some promise with targeted marketing. They seem to be actively managing their debt, taking on new secured loans while paying down others. However, the company is in a tough spot. They've got a history of losses, a lot of debt, and their wholesale business is facing stiff competition. The reliance on Amazon for sales is also a significant risk. The increasing costs from tariffs add another layer of complexity. For Luvu Brands, the challenge is to significantly grow their direct-to-consumer sales and find ways to reverse the decline in their wholesale segment. They need to manage their debt carefully and demonstrate a clear path to sustained profitability. Right now, the numbers suggest they are in a defensive mode, trying to manage costs and borrowings while navigating a challenging market. Alright, that is our decoder for Luvu Brands' latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.